Mercia came about through a management buyout, actually, back in 2010. And specifically, it was formed to address two market challenges. The first market challenge was, if you're a business based in the UK regions, and I'll refer to UK regions a lot in this presentation, and what I mean there is outside of London. You're a business based in the UK regions, it is really challenging to get hold of capital, debt or equity, and get support for it. And the other challenge is if you're an investor and you're based in London, and you're looking for great investment opportunities, there is a huge oversupply of capital in London, chasing quite a few opportunities. So investor returns in London are going down because of the oversupply of capital. What Mercia did back in 2010, and we had 12, 13 million in assets under management then, was try and bring those features together, take capital from the capital, and take it out into the regions. And this presentation will talk to the progress against that. And that progress really has resulted in Mercia today being an active specialist asset manager, but now with 500 million, so £500 million in assets under management. So back in 2010, we had 12, 13 million. We listed in 2014, December 2014, on AIM. And today we've got about £500 million. And that £500 million is via third-party debt and equity funds, so other people's capital we manage, alongside our own proprietary capital, our balance sheet capital. And that balance sheet money, that proprietary capital, goes into the funds we manage as a limited partner, as an investor in those funds, and it also selectively goes into businesses within the funds as we look to scale those regional businesses. And what we do is we bring together that regional presence, and I'll talk to that, operational and entrepreneurial insight. Many of us have built our own businesses and grown them historically, combined with investment experience and expertise, and we think those come together with a very unique and sustainable competitive advantage. And the strategy going forwards here is to leverage that advantage through a profitable asset manager, which will deliver returns above and beyond that from the investments from the proprietary capital in addition. Just to put some context here, across the United Kingdom there are 5.6 million SMEs, small to medium-sized enterprises. And only 4% of those will go on to deliver a 1 million turnover or more. So a very small amount of those will actually go on to deliver anything in terms of growth. And only 0.4% of those 5.6 million businesses go on to turnover over 10 million, growing at a 20% per annum rate, what is defined as a high growth firm. And that's where venture sourcing is. And part of what we manage is venture capital. But we also manage private equity and we manage debt funds as well. And those are towards the latter end there, looking at those later stage businesses. And those three asset classes, what we've built, quite a compelling track record, and I'll talk to that track record in a moment. Our focus across the group, first of all, is see the best deals. So we operate across the regions. We have an internal focus on seeing all or a majority of the deals done within those regions, making sure we have access to the best deals being done. Once we've made those investments, either through the funds or through our balance sheet, it's now a precursor to exit is growing the NAV, growing the net asset value of those businesses, and increasing assets under management. As you've seen, the scale of growth at Mercia is strong, and it will continue to do so. We are looking to scale this business at that same rate going forwards. But fundamentally, it's about realising value. Yeah? It's not about just growing these assets, it's about realising value. Today, I'm really pleased to say, and we'll talk about the funds, we've returned over 170 million cash back so far to our fund investors. We are returning capital back. We've returned 2.5 times now of what we've deployed across our funds. And how we do that is we operate what we think is our regional advantage. Now, it's worth spending just a little time on these slides, actually, to bring this to light. So this is data. This is not our data. This is data from the likes of Bowhurst, from British Business Bank, from the BVCA, Venture Capital Association. And these are all proportionally done. So these blue dots are where, as a percentage, and this is just equity, so it excludes debt, where equity has been put to work over 2018 across the United Kingdom. And that one large blue dot there isn't the South East, that's London. So nearly half of all equity in 2018 was invested in London. Okay? And you look at the regions of the proportion that goes across there. So this next one, if you remember those high growth firms I talked about growing at 20% per annum, this is then, and these two schematics are proportional to each other as well as within each other. 20% of those high growth firms are found in London. And actually, you look at the size of the the blue blobs across the United Kingdom. That's where the high growth. 80% of those growth businesses are outside of London. And where Mercia's offices are, and you have to forgive the schematic, it looks like we've lost Scotland and Wales, but they are there, trust me. But where our offices are, across the Midlands, across the north of England, across Scotland. We have 8 offices across those regions. We now have 85 employees out there looking for those deals that I talked about, accessing that capital, supporting the businesses. We've got 19 university partnerships. They're all within those regions, and about 15 to 20% of our fund's activities are from those university spin-outs. And these are our university partners that I talked about: Edinburgh, Birmingham, Warwick. You'll recognise a lot of the universities there. And over that period, since 2010 to date, we've done about 50 spin-out businesses. And as I said, it's about a fifth of our deal flow now comes from those universities, our partner universities. This is a really important model and a real differentiator as what we are as an asset manager. The light blue part of this triangle is our managed funds, those third-party funds I talked about. We've got approximately 370 million in third-party funds, and within those third-party funds, we have about 200 million of free cash to invest over the next 3 to 5 years. And those are the businesses that we're investing across the UK regions. The dark blue is our proprietary capital. Today, we have about 30 million cash in hand on the balance sheet to make future investments, as I said, cornerstoning funds and investing selectively into businesses in the light blue as we scale them and bring them across to the balance sheet. When they come across onto the balance sheet, we're looking at a 3 to 7 year period to exit those businesses, to turn those back into cash and recycle them back onto the balance sheet. Within the funds, we have a much longer perspective here. So what this means is that when a business comes into the funds, we take a 7 to 15 year opinion as to investment to exit. But on the balance sheet, on the dark blue, we're taking a 3 to 7 year opinion. And just showing the scale of Mercia's growth, 2 years ago, 2017, we invested 46 million across the group, across the funds and across the balance sheet. Last year, 2018, in fact, towards this financial year end, we've invested 65 million across the group. Every other working day, we've been making an investment. We've invested in 143 businesses in the last 12 months. We've seen 2,800 business plans in the last 12 months. That's up from 1,800 the year before. So the pace of growth and the importance of us as a UK regional investor, as a domestic investor, is tremendous. But the opportunities within the regions are multi-billion. So we've invested 65 million. There's a lot more to go for. So we are very focused in the regions and very focused domestically. But as I said, it's a track record. The next few slides are about track record, about how we've delivered returns. So Blue Prism, which a number of you may be familiar with, we were the seed investor, the founding investor in Blue Prism, business based in Liverpool. We've made 100 times our money back and returned that back. Science Warehouse, full cash exit, sold to a PE-backed business, advanced company, Leeds University spin out, full cash return back to our balance sheet. Alinea, business based in Coventry, University of Warwick spin out. The funds made 26 times their investment cost, balance sheet made 21 times its investment cost, full cash return, sold to Arm. All regional businesses. And then down into the funds. So these funds here, the first one are the debt funds. I mentioned we do debt, private equity, venture. The oldest debt fund is the FY loans. FY is Finance Yorkshire, so the Yorkshire fund, and that's our oldest one that's unwound completely, returned money back. Once you've taken fees, everything else, that's 106% gone back to investors. We've got about 100 million in debt funds and approximately 70 million in free cash to invest going forwards. And there's 200 companies. We've got, across all of our group, 400 portfolio companies we've supported so far. It takes me on to the equity. Circa 300 million under management, 130 in free cash to invest, as I said, going forward to 200 companies. So that's the 400 makeup. Our oldest venture fund, our only fund so far to fully unwind and return capital back. We just closed that in March. That's got an IR of 15% at fund level, so fees after fees, etc., being returned back, or 18% at portfolio level. And it's returned 553% of the capital back to investors. CGF, and that's a business, that fund is exclusively north of England. Just invest in the north of England at a regional basis in young venture businesses. Coalfields Growth Fund, Midlands and north of England. Again, an equity gap fund. We've done very, very well from that. 19% IRR, returned 245% back to investors in that fund. The EV growth fund there at the bottom, actually that's still going through. So these numbers here on returns so far. So that's done a 13% IRR on cash returned. We returned 178% of money back. There's a lot more still to unwind from that, so I expect the performance to be markedly improved in this fund. So our old funds have done very well, and as I said, we've returned now £174 million back to investors from those funds. But also the balance sheet, which is in a very good place at the moment, a very strong portfolio. And we've got over 20 businesses that we've invested in the balance sheet capital, as well as into the funds as well, of course. And these businesses are predominantly in revenue growth. And what I'll now talk to is just 4 of these businesses, which are our 4 largest holdings. After this presentation, more than happy to take comments and questions on any of those businesses, of course. Now, the average holding time of businesses on our balance sheet is about 2.5 years. So quite young as a fund, if you like, if you look at the balance sheet. But the businesses themselves are quite mature, between 5 and 10 years old, because they've been in the funds before they've come to the balance sheet. And the commercial partnerships that they've struck then reflect that. And most of our businesses, and certainly the ones I'm going to be talking to in a moment, are between a 50 and 300% revenue growth. So these are businesses in strong revenue performance at the moment. nDreams occupies the virtual reality space. So it's got its own content it's delivering and bringing through, and it's got partnered content as well. With the major VR headset providers down there, it's partnered with all of them. Back in the summer, we announced a multi-million-dollar contract they secured. We expect more good news to be coming out from what is now one of the leading VR content providers globally. We have a significant stake, and this is our largest by value holding. Warwick Acoustics, University of Warwick spin-out. This has got flexible electrostatic speakers, sort of the thickness of cardboard. You can cut them to any shape, you can bend them into any shape. The headphones under the Sonoma brand really were sort of just showing that we can produce this at a scale and at a high quality sound. And the headphones are obviously selling globally, but the real market opportunity here is in the automotive sector, where we can have these in this, you can basically have sound where you need it. You can have it in the headrest behind you, you can have it in the ceiling panels, you can have it cut to shapes in the A-frame of the car, and they're doing that with a number of automotive manufacturers at the moment. We expect that to roll out in the fullness of time. In Technica, they have a product called Netacea. Now, most of you won't realise that 90% of online logins are through bots, not through humans. It's remarkable. And websites are constantly being brought down by bot traffic. And that bot traffic can be malicious or it can be normal. And if it's normal and it's a busy read through onto your website can be brought down by the traffic that's going on there. Now, Netacea sits in the cloud, sits ahead of the product, and it interrogates the traffic coming through in real time. It's got a machine learning algorithm in there that can very quickly categorize normal behavior from malicious behavior, from behavior where you've got competitive products coming across and scraping data so they can use it on their comparison websites, etc. It's a very, very exciting business, fast growth business again. And here's a great example of what it means in reality. So they work with a number of tier 1 providers. The top one there, the dark blue, the red is where, this is a United Kingdom-based business, okay? So what they do is they loan this product out on a month basis. So you can see that's clear, that's what you like it to be. But during that month, the bottom picture is what actually developed. And on the bottom picture, you've got something like 144 countries sending through over 1,800 data centers malicious attacks, 164,000 malicious attacks coming at this one internet website. And the ones that are in blue is nobody lives there. So frankly, it's global attack on this one internet site. And what Netacea does is it sits in front of that and protects that domain. A fabulous product. And on a cybersecurity basis alone is invaluable. And then finally, in terms of the portfolio, is Oxford Genetic. So Oxford Genetic is a synthetic biology business. And I have to confess, I've got a bit of a personal interest here. So I'm a type 1 diabetic, okay? So synthetic biology, insulin is a great example of a synthetic biology product. 1982, I was diagnosed with diabetes, type 1 diabetes, and for the first 6 months, I was injecting purified pig insulin. And then Genentech came along with Humulin, which was the first synthetic biology product to come onto the market. Today, I don't know if I've got it here. Yes, today, I inject insulin now, which is better than anything you guys produce. So so the way the market has moved now is synthetic biology is outperforming evolution, frankly. So which is remarkable, absolutely remarkable. And so the challenge now is how do you produce these things? So 50% of products now at the FDA for regulatory approval are biologic-based. And that is being driven in large part by synthetic biology. So the challenge now is how do you get to high volume, high scale, and low cost on these? And I've got a very short video here, which is of Oxygenetics now. And we made an announcement in the summer and a multi-million-dollar contract that they secured as well. And what they've done is they've brought software, robotics, and absolutely cutting-edge synthetic biology together. And at this point here, they're screening tens of thousands of clones on a daily basis. It works on a 24/7, every day, every week, every month throughout the year. And it has just 2 technicians that operate this, whereas originally you'd have had 25 to 30 people operating this search through. So each time they win a new contract, they fill a room out with these robots and away they go on that. And so that's why that business has been running at 100% revenue growth, and this year it will do just under 300% revenue growth. That's a very exciting and a very scalable business. Martin.
Thank you. Thanks. Good evening, everybody. I'd just like to take a couple of minutes just to talk 1 or 2 numbers for you. Mercia's model is clearly about looking to identify exciting growth businesses that we can invest in, but Mercia itself is an exciting growth business. And these couple of numbers give you a feel for that. So what you have here on the left, 2015, just after we'd floated, our first interim results, we had revenues of £700,000 and the assets under management were 104.7, but that included the 70 million that we raised on our float. If you roll the clock to our most recent interim numbers, that revenue's grown to 5.3 million, and as Mark said, our assets under management are now £500 million. So this is Mercia's growth trajectory. These are our summarised interim results from last September, with revenues that have grown by 10%. The vast majority of that revenue is contracted. It's long-term fund management contracts, so we can always see when we're budgeting, we can see ahead quite clearly what our revenue streams are likely to be. So 10% there. Our cost base grew by 5%, and that's mainly the investment professionals who are managing the funds under management for us. And as a result, our net expenses is declining. And that is a real focus of ours, to take that net expenses to net revenues. And over the next 3 years, we have a strategic plan to take this business, well, from £500 million today to £1 billion of assets under management. And that will take us to profitability comfortably. Our balance sheet portfolio is growing in value, both from the amount of cash that we invested. We invested 9 million in the first half, about the same in the second half, but also the fair value movements. The value of our portfolio is growing through syndicated investment rounds, other people investing in our portfolio at higher prices. So as you can see at the bottom line there, we're a profitable business with a balance sheet of about 125 million at the end of September, with about 38.3 million of unrestricted cash. This is our balance sheet portfolio, detailed in our interim results, audited every 6 months by Deloitte's. As you can see here, the spread of our sort of top 20 investments. Mark's talked about the top 4. As you can see, 98, 99% is spread across these 20 companies. And no company really dominates that portfolio. Yes, Endreams is our highest valuation, but there's no one there that absolutely sort of dominates. You can see how that 9 million was invested in which companies across the first 6 months and where the fair value movements came from. Very typically, the portfolio breaks down a third in terms of how much have we invested in each of these companies. So if you took the bottom third, they're probably amongst our youngest investments onto the balance sheet. We've probably invested between 1 and 2 million into those. The middle third, we've invested probably 3 to 4 million. And then in the top third, we've invested somewhere between 5 and 7 million into each of those companies so far. We're often asked around our share price, because our share price is at a discount to the net asset value of the company. Net asset value at the end of September was 41 pence. And what we say is this is the makeup of our balance sheet. And the balance sheet, as I say, was 41.3 pence per share. And you can break it down by the main constituent elements of our balance sheet, the vast majority of which, of course, is our portfolio, which I've just talked about, and our cash. However, we do have a profitable fund management business, turning over about 9 million per year, And on a valuation business of, say, 3 times revenue, that would be worth £27 million on its own, and that isn't reflected in our share price. If you added that back in, you'd be at a pro forma share price of about 50p, which by coincidence is our float price. So we, and all 4 execs bought shares, you may be aware, bought shares last month. We're very excited about Mercia's trajectory.
Thank you. So just to repeat really what our focus is, and I hope you agree with us, we do see the best deals. We're transacting. We're the 4th most active national investor now and 2nd within the regions. We're really growing fast at the moment. We are growing NAV. Our funds are performing well. Balance sheet is increasing in value too. We're absolutely growing assets under management, and we have every expectation to continue to accelerate that growth. And we are seeing realised value coming back, both in terms of our funds and in terms of our proprietary capital. Thank you very much for your attention.
Very good. Questions here, please, Peter, first hand.
Thanks for your presentation. Any reason you are not giving any dividend? Thanks.
Shall I do that?
Yeah.
Yeah, okay.
Do that?
Because at the moment, we have net expenses. So once our revenues exceed our cost base, which is our investment professionals, once we've built this business a bit more, once the assets under management have grown a bit more, then we'll become a profitable business on a cash flow basis. And at that point, and we'll be having realised gains from investments that we've then sold, over time, we absolutely are determined to become a yield stock.
Yeah. We're 4 years old, just over 4 years
4 years old.
And so we're still building the business, but our expectation is in the near to medium term, this business will be generating yield without realised gains. The realised gains is, if you like, the thing that adds on top of that.
Yeah.
Thank you.
Other questions, please? As a quickie, you had business there 4 years old. What's been the greatest challenge in that time? What's been the thing that's been the most difficult or the greatest challenge?
So pace of growth, really. I mean, when we floated, we were 5 people. So, and we're 85 people. So making sure that you keep up with pace of growth is been quite a challenge. We have systems in place now that we can be, that's why we can be so confident that we can scale this business, because we've got those systems in place. And I think the other thing, which is why we're at great events like this, is actually communicating. The challenge has been communicating succinctly to the market progress we're making. Most people don't know we have £500 million of assets under management. Most people don't know that we've returned 174 million back to fund investors so far and at the pace. And most people don't know that we have one of the best performing venture funds in Europe. So it's beholden on us now getting our communications out there, and what we're doing is making sure we talk to retail investors, talk to good people like yourselves to update you on our progress. And that, I think, has been a challenge to keep up with everything in terms of the pace that we've been going through.
Other questions, gentlemen at the back, please.
If you had the balance sheet for it, had grown it, how many more companies could you put in from your current early stage portfolio?
Yeah, that's an excellent question. We have, as you would expect, models within funds and models within the balance sheet. So the optimum portfolio size, everything has an optimum portfolio size and balance, of course. On the balance sheet, it's about 40, 45 companies, and we're about 20, 25 at the moment. So we're not there yet to get to the optimum size. And the optimum size means that you've got businesses leaving through exits, and you've got businesses coming in. And we're bringing across between 2 and 5 businesses a year onto the balance sheet. So we are suboptimal on the balance sheet, but we expect that balance sheet to evergreen. Because frankly, what we don't want to do is to be constantly coming back to the market to raise capital. We want the funds to be working, we want the balance sheet to evergreen, and we want this business to be a yield generation for our shareholders and for the owners. What I haven't said is 25% of this business is held by employees and by the board. So we are fully aligned with our shareholders. Absolutely. And making sure we deliver growth to shareholders here.
Gentleman here, please, Chris.
Hi. You showed a number of examples that were spread across multiple, what I would call high-tech industries, biology, acoustics, cybersecurity. Do you have experts in your business that can help you identify good opportunities in these fields? And if not, how do you make your investment case?
No, so we positioned ourselves as a specialist, as an active specialist asset manager, and that specialism is absolutely, to your point, absolutely critical. So we have technology expertise in-house. We have a platform, actually. We have a corporate advisory function, we have our own legal, we have our own research, and we have our own technical expertise internally to make sure we pick those deals. We also have a team that works in the private equity who specialises in a space there. And actually our debt team are bankers. We have a team of bankers who pick great deals and do, a fabulous track record. So we have, if you like, pools of expertise that align with the transactions that we make.
Thank you.
Anyone else? One more? Oh, I've got one question. From the 400 fund investments in the funds, 20 on the balance sheet, what would you forecast your hit rate to be? How many of those do you think are going to go on and be successful businesses? What's the industry average, and what's your return so far?
So I think our industry is more. So we operate more akin to the US. So I always look to the US because the venture community within the UK and within Europe has not been particularly brilliant as an asset class. So we look to the best performers to match our track record against that. And that's different. And that's why we do these three asset classes. It's different in private equity, different in venture, and different in debt. In debt, you want pretty close to zero failure rate in that when you're returning. Private equity, it's a very small failure rate, 20%, 25% failure rate. In venture, it's about a 70% failure rate. Okay? So, it's a brave game, venture. And that's why, to the gentleman who asked the question about specialist knowledge, you better have that internally when you're picking those businesses. So your risk profile, your capital returns profile has to be allocated appropriately to the asset class that you operate in.
Okay. Gentlemen, thank you very much indeed. Thank you very much.